Well, hi, and welcome to the third session of the Science of Creating Wealth. And thank you for coming, and thank you. I've spoken to a couple of you this afternoon before we started, and I'm excited about what we're going to talk about today. And I'm going to just kind of continue on with what we've been doing already and what we've been visiting about, and maybe go back just a moment, just spend a moment or two. I think probably today we're going to be spending maybe someplace around 40 minutes together, maybe a little longer. And the next session, what I want to just to kind of give you a clue on, I want to talk the next session about mistakes that investors make relative to, I'm going to stick on the investment thing. So Seminar 3 is, the focus of Seminar 3 today is sound investing and the idea of save first, invest second. And again, I want to remind you as we go through this together that this whole process of what I have referred to as the science of creating wealth is a system. It's very difficult to take one little piece out of a system and expect to get the kind of results that you want to get. And so many times when I've experienced in all the years I've been not only practicing dentistry, which I still do, but also working with so many dentists, is that they grab a little piece here and they grab a piece of that, and they don't really put it all together. I think we're great about taking things apart, but don't think we're so great about seeing the whole. So again, I want to remind you that I think it's difficult, if not impossible, to piecemeal your way to wealth. So thank you for coming. And so again, as I covered in the session before, the first step to creating wealth is you've got to continue to prepare your mind to receive it. I don't know how many of you, because I haven't looked at the updated list I did earlier today, have been on each one of these, but the idea is that we have to always program our mind. So you should have been doing this work. You should have been thinking about the exact money that you need and the amount of money you want and the exact amount of money you need. And the second piece, which is almost, in my view, as important as the first, it really is for me, not for everyone, is to decide exactly what I'm going to give in return for what I want. That is the amount of money that I want. And remembering there's no such thing as a free lunch. And the other piece is have a definite date when you intend to create the amount of money or the wealth that you've determined is the number for you. And also there has to be a coordinated plan for carrying it out, both the desire and the purpose, and we got to get started. Okay? I'm an advocate of 10-year plans, and I want to talk about that just a moment right now. A 3-year plan is a short-term plan and a wonderful plan, but 10 years, because, and the reason 10 years is, you can have a bad month, you can have even a bad year, you could have a good month, you could have a good quarter, you could have a good year, but over the long term, what we're looking to do is to develop a system. We're looking to develop a pattern of behavior. We're looking to develop a way of going about functioning and operating in our entire life, and money is certainly a part of that. It isn't everything, but it's certainly a part of it. So once we really work on our plan, we need to write it out. It's critical. It's absolutely critical to write a clear, concise statement of the amount of money that you intend to create, name the time limit, and state exactly what you intend. In other words, how are you going to create value in return for the money that you're... So we got to describe it clearly, and we have to describe it completely. And we have to also remember, and this is critical, you got to read that statement aloud. This sounds phony to some people, but there's something that happens when you take something out of your mind and you write it down on paper. There's something else that happens when you continue to read out loud your statement morning and night. As you read it over a period of time, because what you're really doing is you're really training your mind. You're really structuring your mind. It's the most important tool that you have. So this is what I ask you to do. I ask you to continue to pay attention to your own self-talk. I'm absolutely convinced that more people sabotage themselves than any other factor. And if I'm not sabotaging myself or I'm letting somebody else do it, you have to be so conscious of the fact that your own self-talk is really what probably gets in your way more than anything else. See, I have encouraged you to write down the thoughts that occur most so that you're able to rethink them and you're able to look at them, and you're able then also to begin to reframe those thoughts. You got to pay attention to how you wake up in the morning. You got to pay attention to what's happening and what you're thinking at the end of the day. And again, as I said, you got to write out the exact amount, put this in a closet or someplace that you can read out loud every morning and night, and read that exact amount and date aloud every morning. And I also put it on a card and carry it with me wherever I go. In Performance Coach, we have a Performance Coach calendar that we use, and I put that on there, and I read it every day, and I also take it with me wherever I go. So we're looking at the fundamentals of creating wealth, and there are just a few things that make all the difference to your outcomes. I love the statement of my friend Jacob Needleman, who says, if you don't pay some attention to money every day, one day you'll give all your attention to money. And isn't that true? So we have to deal with our mindset. It's probably the most important piece that we deal with. Some people have simply more desire than others, and I can do nothing about someone's desire. But the goals and plans are really, a goal is a structure. When you make a goal, as you know, you can't have everything, but you can focus on those things that are most important to you. And so as you create a goal, that goal is really a structure. And of course, you have to follow it up with a plan. And you have to believe, you have to have faith in yourself and believe that it's possible. And if you don't believe that it's possible, then what's going to happen is we're going to be sabotaging ourselves all the time. And that's why I've asked you to pay very close attention to what you're thinking in the morning, what you're thinking during the day, what you're thinking at the end of the day. And the whole process of writing out and thinking about what do you want, but also thinking about what are you going to give in return for what you're going to get. How are you going to make a difference in someone else's life? How are you going to create value? It's fascinating to me that of all the dentists that I meet and I deal with, that there are very, very few that ever end up creating true wealth. And from that creative visualization is the idea of commitment. On the back of my card, the center card, it says, commitment is the willingness to be uncomfortable to produce results. I was talking to a dentist on the phone a few weeks ago, and he said, I really don't like change. I really don't want to change. And then I said to him, well, then what are we talking to each other for? Because, if you want something that you don't have, or you have something that you don't want, the only way you're going to do it is to make some commitment. And you're going to have to change, because all growth is related to change, and we're going to be talking about that today. So the other issue that we talked about is the idea of creating wealth is, and everybody has a different perspective on this, so obviously in these sessions you've been listening to mine, and I don't hold up I'm not an authority on this subject. It's just the issue that I've been working with so much. Wealth is the idea of organizing your thoughts and actions in some way into a path or style of living, The idea of happiness and peace of mind is living your values and having your beliefs and having your values in balance. I spoke with one of our young dentists that's in the management program right now, and I said, isn't it wonderful when you go through the process of the practice development program that you're able to write out each policy, each system, every activity you're doing, and it's in concert with your values, your beliefs, your purpose. So it really becomes you. It becomes yours, So, the issue of what we talk about so often is the sense of order together with freedom. Financial freedom is really, really a difficult subject, and I'm going to talk about it more in another webinar that we're going to have together, because we're recording these for future. I don't meet very many people that are really free of money, no matter how much money they have. I spoke with a man the other day who wants me to work with him on an app project for an iPad, and his minimum client that he works with, his minimum client is a net worth of $100 million. And he works with billionaires, and he said, I don't have anybody that feels like they have enough money. Is that amazing? Many of these people that have a tremendous amount of money are overcommitted with philanthropic things, giving money away. It's amazing. Okay? So somehow or another, the issue of becoming free. So to a certain sense, financial freedom, economic freedom is really the purpose behind the idea of creating wealth. It's feeling a certain sense of satisfaction, which is very difficult in the economic climate we're living in today. The peace of mind, fulfillment, the idea that your life makes sense, having an abundance outlook, that there's enough rather than a scarcity outlook. I rarely meet a dentist, and I know I'm talking to dentists that are clients of mine and friends of mine and have been long-term students. I rarely meet a dentist who's got an abundance outlook. The majority just feel like there's just not enough. And of course, how does it feel to live a whole life, your whole life, feeling you don't have enough, no matter how much you have? So the people that have the abundance look are really living above the line versus those and are aspiring and creating versus those that are living below the line. And I, have been using this when I do seminars now, and I really like it. I talked about it in our first session together, and I want to read it to you again. What you think determines how you feel, which impacts what you see, which determines what you choose, which determines what you do, which creates what you have. Said in reverse, what I have has been created by what I've done, which has been determined by what I've chosen, which has been impacted by what I saw, which was influenced by what I felt, which all started and was determined by what I thought. So when we look at this and you think about this, again, I want you to think wherever you are right now is your comfort zone. It's your current reality. It's where you are at this moment. In order to move to any other place other than where we are, the most important way to structure our minds and structure then our activities is goals. But simply having a goal without understanding why we want it. Okay? In other words, if where I am is my normal, if I'm going to increase my performance in any aspect of my life, mentally, emotionally, physically, financially, in my practice, in anything, I'm going to have to first set some specific goals. And then I'm going to have to really know and understand why I want those. What am I going to have when I get it? What am I going to have there? So I'm really programming my mind again. And when I begin to do that, I begin to put into place a set of driving forces. I begin to release the energy, and I begin to release the desire to move me towards that. But on the other hand, irrespective of whatever I attempt to do, I don't know what you've experienced in your life. I put this together after looking at Kurt Lewin's model, and I felt that it was incomplete. It was great, but it was incomplete. There are always restraining forces. And I say to people, picture playing tennis without a net. Picture playing golf without an out of bounds or without sand traps. Picture watching a football game where there's an offense and no defense. It's the way the universe works. The way the universe works is whenever you have a goal or a desire, there's always something in your way. There's always some kind of restraining forces. So what happens is when you don't have specific goals, or I don't, as a human being, don't have specific goals with specific payoffs, what I see is the obstacles. But when I have the specific goal with specific payoffs, what I see is the outcomes I'm trying to create. I went through and spent quite a bit of time last time talking about what I believe. Now, this is just my belief after all my work and stuff. I believe that the key to whatever level of achievement, whatever level of accomplishment that any of us has in our life is our own self-image, which is the picture we have of ourselves in that arena, and our esteem, which is the rating of it. I think it's the most powerful and important limiter, but also facilitator of you creating wealth, and that's your self-image and self-esteem. Because if you don't think you're worth it, if you don't think you deserve it, I guarantee you, you'll sabotage yourself. Or you'll let those around you sabotage you. Could even be the people that are right in your own home. So years and years ago, I wrote out these 8 habits of economic freedom with 3 core strategies from the richest man in Babylon. Now, he said learn how to make it. I say learn how to earn it. First thing you have to do is learn how to earn it. The second thing is most important thing, and many of you know who've been students here at the center of mine, and is that we focus heavily on keeping it. What's the use of making it if you don't keep it? You know, if all you do is focus on earning it and you don't keep it, what you find is you're spending your life as a money machine, making money but spending it. And the third, see, this is interesting because people that spend money learning how to keep it are far better savers and investors than those that haven't done this, because they're always down here looking for some kind of a killing, you know. And I'm going to make a real strong pitch today that, you know, there's no sense saving it and investing it if you're going to lose it. It just doesn't make sense. So the first law is to learn to create value. Second law is to save 10% of what you earn, you know, because we're all going to be subject to lifestyle creep. It's so easy to allow our lifestyles to go up, but it is so difficult to allow them to be retracted. You know, I talk to dentists every day, and every dentist I meet, whether they're netting 100,000 or they're netting 6 million, will tell you, gee, but you know, we really don't have spend that much money. You know, we really live conservatively. You know, I talked to a dentist just this week who's taking in $1 million, and he watches every penny in his office. And I said, do you have a budget at home? Do you know how much? They have no idea what they spend at home. Not a clue. Don't even look at it. So the idea of controlling your expenses. I love this statement by Klassen, right out of his book. Now, he said, I'll tell you a truth about men and women. Whenever your income grows, your expenses will as well. Unless you protest to the contrary. Spend what you will, but always save 10%. And I say that 10% is to permanent savings. And so this is where we're going to be looking today. Never lose money. It's a bold statement. But each and every dollar has got to be thought of with some return. Otherwise, we're just going to spend it and lose it. And so we've got to invest in what we know before we invest in what's unknown. And so many of you know, and that's not the subject of today, so I'm not going to get into it, the issue of paying off debt. And obviously we want to use compound interest where we can. And these last 2 laws have to do with ensuring a future income and obviously always increasing our ability to earn. So all of that took 19 minutes. In the next few minutes, I'm going to talk about something that I think is so very important. And this is a quote out of the book written in 1970 by Alan Toffler called Future Shock. It's the very first paragraph in his book, and he says, the 800th lifetime of man. In the 3 decades between now and the 21st century, millions of ordinary, psychologically, that is previously psychologically normal people will face an abrupt collision with the future. So he's talking about 1970 to 2000, year 2000. Citizens of the world's richest and most technologically advanced nations, many of them will find it increasingly painful to keep up with the incessant demand for change that characterizes our time. For them, the future will have arrived too soon. And we are in the middle of the largest significant shift in any culture that since we've been alive. We are in the second Great Depression. We're 3 years into a recession, and the unemployment continues to increase. So I want to bring to your attention the idea that Joseph Schumpeter he actually created, or the word creative destruction, much as Alvin Toffler coined the word future shock. And Joseph Schrempter talked about creative destruction. He said in his vision of capitalism, innovative entry by entrepreneurs is the force that sustained long-term economic growth, even as it destroyed the value of established companies that had enjoyed monopoly power. Think about Xerox and copiers. Think about Polaroid and instant photography. Think about Sony and the Walkman. Sony was busy kaizening the Walkman as Apple was busy creating the iPad or iPod. Think about Montgomery Ward's Sears and Kmart. Think about General Motors, Ford, and Chrysler. So as we look at, using George Land's terminology, the world at breakpoint, creative disruption is exactly what we have today, which leads to creative destruction, which leads to new business methods and models. Now, this is not only true of every organization that's operating in the country today, but it's also true of, guess what? You're in my practice. So here's the thing that we need to understand about capitalism. Even though we all are feeling the force of down-leveling and the pull to socialism, capitalism never is and never can be stationary. It's by its very nature, it's a living entity. So creative destruction is interesting because organizations are built on the assumption of continuity, so their focus is sameness and stability, whereas capital markets are built on the assumption of discontinuity, and their focus is on destruction and new creation. So spurts of innovation destroy established enterprises, yielding new ones. And this is George Land's picture of, as a biologist, this picture of how this occurs in nature, in biology, and it also occurs in every business and within every human being that's ever been developed. There's the first stage, which is forming, where you're trying to figure out what's going on in your business. The second stage is really expansion and duplication up to a certain point. It is modification, and some discrimination, but at a certain point, no matter what it is in nature and what it is in an organization, it reaches its third point. And the third point is, whether you want to call it a midlife crisis, whether you want to call it a crisis of limitations, at this point, the organization begins to decay, begins to die, begins to experience entropy. And at this point, this is what Land refers to as breakpoint, when you take off and begin again. Now, why am I bringing this up? I'm bringing this up because we're in a period where the most innovative changes we have ever experienced are occurring. And I've got news for you. They aren't going to stop. The innovations are going to get bigger, and they're going to create more and more creative destruction. They're going to kill more companies, and new ones are going to emerge, but they're going to be very different, and they will be very, very much better. So there's going to be more rapid innovation and change than we've ever seen. And so recessions are going to come sooner, faster, and they're going to be deeper. So get ready for another one. Economies and markets and people will be hard-pressed to keep up. The traditional investing strategies of the past that your typical financial advisors are offering you and doing for you are dead. Okay? So that issue of future shock, I just love it because it's just proven to be so true. So these are the things that we know happen in recession. Sales decline, receivables increase, credit will tighten. An interesting thing, I can't spend a lot of time on this, but an interesting thing that we see is we see dentists who have been, so to speak, in trouble. They have not been doing well, and so they've been borrowing more and more money, on credit cards and what, and they get to a point where they really need help, but they can't get money anymore because their credit's so bad. So let's look at recessions. This is the amount of recession. This is the depth of the recession, and The diffusion is the percentage of the individuals that are impacted by it. 19, 20, 21, year and a half. 12% unemployment. 97%. 23, 24. Right after that, 1.4, 5.5. Now, we'd kill for a 5.5% unemployment. I think 5% is about normal for this culture because a lot of people that can't work and don't want to work. 29 to 33, 25% unemployment, 3.8 years. Mark that someplace down if you're taking notes and think about it. 100% of the population was impacted. And so it really wasn't over because 4 years later had another 1.2 year with 20% unemployment, 98% of the population was infected. So we went a good 10 years and then had another one, but 8% unemployment. Now keep in mind, back in those days, if you look at normal unemployment rates, they were normally around 2%. 53, 54, another one, 6.1%. 57, 58, 4.5, not too bad. 73, 75 was my first major recession that I personally experienced. 9% unemployment, 88% diffusion, 81, 82, 1.4, 11%, 72%, 90, 91, 2 years, 7.7, 80%. We thought the world was going to end. 2001 to 2003, 7.5%, 75%. Here we are now. 2007, approximately October of 2007, we're beyond this mark. We're at 2.6, almost 3 years, 9.8% unemployment. We really believe the figure's higher because there's so many people that have stopped looking for work. Now, this is when we start talking about investment. So there is a correlation between unemployment and investing, but let's look at this together. I could go back further, but I went back to 1945. When the S&P at its high was 25, the low was 13.55. So that's a 30% decline, and it lasted 1,111 days. That's a sizable length of time. And then it did what it always did. It went up. It basically went up 300%, 400%, and then it went down. It went down 22%, lasted about a year and a half. Then it did what it always does. It went back up, and then it went back down to 53. It went down to a new high-low, and a 28% decline. Lasted about a half a year. And then it did what it always does. It went back up. It went to 94, and then it did what it always does. It went down 22%. Okay. Now, so it went to a new high-low, lasted a little over half a year. Then it went up considerably, and the reason I have this in yellow is because it went down more. It went down to a low that was lower than its previous low, so that was a 36% decline, or it lasted about a year and a half. And then 5 years later, 73, it went, that's interesting, that's when I started in practice, that's when I moved to practice. It went up again considerably, almost doubled, but then it went down lower than it had before to 48% decline, lasted almost 2 years. And then it did what it always does. It had a nice run there, went up to 140, and it went down to a new high-low of 27%, 622 days, almost 2 years. Then it went, we had that kind of little bubble there in 87 when the market crashed, and it came back pretty quickly within 3 months. And then it went to a new high of 368 and a new low, a 20% decline in 1990, and then in the year 2000, see, it had this really nice run. And this is where a lot of people went to sleep because all you had to do was be in and go downstream, and you were making money. It didn't make any difference what mutual fund you were in and probably any stock you were making money. But then look what it did. It went down 49%. It lasted almost, though not quite, 3 years. Okay? We no sooner recovered from that, and we never really did recover from that. It ran back up to 1565, and then it ran down 57%, and we're approximately in somewhere around the 880th day. So now, today, as we speak, the market is close. The S&P is close to 1,083, but it's still down 30%. Now, if you look at this, you begin to, and you look at this pattern, you see there's a definite pattern here between highs and lows. It's very difficult to say what the high is or the low is. This is what I want to share with you. This is really important. So when the S&P was 1565 and you were invested and it went down to 667, it went down 57%. It hasn't gone down 57% since the Great Depression. Okay? Now it's come back, but to go from 667 back to where it was, it has to come up 234%. Okay? Now, there are a couple things here. One, if you held everything that you owned, and it came back, it doesn't necessarily mean that your investments came back, because what comes back is not always the same as goes down. So if you look at this, to me, this explains why the average investor rarely ends up with creating wealth, in spite of saving money their whole life, because you're willing to lose it, and your investment advisors tell you. By the way, I can't tell you what to do. I can only tell you what I do. I'm not an investment advisor. So what happens is your investment advisors tell you to hold on. So you do, all the way to the bottom. And every few years, your net worth gets halved. So years and years ago, I mean, I'm talking 25 years ago, when I was really looking at this for myself, I thought about, and I built a model. I built a model on really, it's 4 tiers, but mainly 3 tiers. Tier 1 is cash or cash equivalents. Tier 2 is mutual funds or index mutual funds, which are better than mutual funds generally. And blue chip dividend paying stocks is Tier 3. And Tier 4 is precious metals, REITs, limited partnerships, real estate, gold. And Tier 4, and the reason you see I don't even really have it in mind, because it's very, very difficult to measure the risk of these things. Very difficult to measure. And we put these into our investment portfolio. But here, it's fairly easy for me to measure the risk here and here. So in any investing, it's always risk and reward. So, if you're really, interested in preserving what you have, rather than simply throwing it to the wind, this is what I do. That's all I can really inform you, is what I do. 1/3 of the money that I have is in cash or cash-like instruments. Now, would I consider treasury bills cash or cash-like? The answer is that. Yes. Would I consider market? Yes. But the third is in some kind of bonds. Okay. Now, it could be municipal bonds, it could be corporate bonds, it could be bond funds. I'm just putting it there to show you. And the third is invested in growth stocks. Now, the problem with this is that one part of this that's going to grow significantly or potentially go down significantly is the growth stocks. So this means that if all of your instruments are in one place, you're able to measure the risk, you're able to know what your diversity is, you're able to know, what your portfolio is doing or not doing. Okay? So we often talk about, well, why use index funds to build wealth? Well, 90% they beat 90% of managed funds over any 5 or 10 year period of time. They don't have the management fees of 1.5% to 3%, or the advertising fees, or the loaded or the sales fees. And the average fund sells 3 out of 4 stocks it owns every year. So if your money is outside a defined pension environment, you're going to pay higher taxes on it. These are a couple quotes from people who have looked at index funds. And I'm not suggesting your whole portfolio should be index funds. I'm just bringing it up. If there are 10,000 people looking at stocks and trying to pick winners, 1 in 10,000 is going to score by chance alone, and that's a great coup, and that's all that's going on. It's a game, it's a chance operation, and people think they're doing something purposeful, but they aren't. Merton Miller, laureate in economics. Most often, conclusions supported by active management can only be justified by assuming that the laws of arithmetic have been suspended for the convenience of those who choose to pursue careers as active money managers. William F. Sharpe, Nobel laureate in economics. So the question is, so investors delude themselves into beating the market. The answer is they're not going to do it. It's not going to happen. It never has, and it never consistently will. Okay? Another Nobel laureate in economics. So active management is little more than a gigantic con game, because you can't beat the market. I have personally talked to this person. He is a advisor for dimensional fund advisors. I've had several conversations with him. Here's his statement. I've been a stockbroker for 5 years and have made people money, but I always lose it in the end. I've taken huge risks with my clients. I've lost millions. I'm tired of looking for new clients. If I've noticed anything over these 60 years on Wall Street, is that people do not succeed in forecasting what's going to happen in the market. Benjamin Graham, who is Warren Buffett's mentor. So I just threw this up, and I'm not suggesting that you buy Vanguard. I just threw it up because it came from them so you can see it. So if we look at a low-risk portfolio, a medium, a high, and a very high, then you can see that you're going to be investing different percentages in different kinds of investments. And the lowest risk is going to be the lowest percentage is going to be of stocks, and the highest is going to be of bonds or cash. And the risk goes up as your exposure to stocks goes up. The gain goes up as your exposure to stock. If we look at these same portfolios, the low is an average of 9% a year. The medium is 9.77, the medium high, and the high. Now, what is interesting here is the worst single year in the low was 1.69%. The medium is 6.6, the high, and you see the losses go up. The worst 2-year is 0.32% with the low, minus 10% with the medium, minus 20, minus 28 with the high. The worst 3-year with the low is a plus 8%, a minus 1, a minus 15, and a minus 27%. Okay? So index funds, when they're properly balanced, not just purchased by anybody at any time, but when they're properly done by someone who understands how to manage and balance the portfolio, makes sense. Doesn't make sense to just jump out and just buy a bunch of index funds thinking that index funds are safer than any other, because they aren't if they're all stock index funds. This is something that I want to share that I've done for years. And I'm a strong believer in Geraldine Weiss's undervalued A-rated dividend-paying stocks. And I'll tell you a little bit why, but I want to show you the ones currently that I'm purchasing. Johnson & Johnson is an A-rated or above stock, paying an average of 3.6 per year dividend. And remember that the dividends on these stocks, they wouldn't be here if they weren't growing at least 10% per year. Chevron is another example, 3.6%. Philip Morris is another one at 4.7% dividend. Exxon at 3%, Coca-Cola at 3.3%, PepsiCo at 3%, Procter & Gamble at 3.1%, Clorox at 3.4%, Abbott Labs at 3.7%, and the Atria Group, which is MO, at 6.6%. So the idea of buying building a portfolio of A-rated dividend stocks is they all have a debt of 50% or less. They pay out 50% or less in dividends, because if they're paying out more than that, They don't have the money to increase their dividends. They don't have the earnings to increase. And they have a PE, a price earnings ratio of 15 or less. So the charts on these suggest a potential for growth. So if you look at this over time and think about 60 years of the consumer price index being an average of 3.1%, if all of your money is invested in treasury bills and it's 3.4, then you're only really making 0.3% on your money. If it's in government bonds, it's 4.2, so it's 1.2. And I haven't put municipal bonds in here. Municipal bonds generally pay about the same. The only difference is they're federal tax free and can be state tax free. So this percentage can go up as high as 6 to 7 and 8% on real earnings. Corporate bonds 4.8, and common stocks have historically paid, long term. This is the S&P 9.8 or 10%. So if we look at this over 61 years, it's you take $1,000 invested at 3.1%, you end up with 6,000, 1,000 at U.S. government bonds at 13, 1,000 in corporate, and 1,000 at 9. This represents 9.8%. You can see that there's a considerable difference. Every percent does make a considerable difference. But keep in mind, would you rather earn a consistent 7, 8, 9% over long term, or would you like to earn 18% one year and lose 27% the next? And this is historically what people do. They're talked into investments, and they're talked into staying in the market, and they lose money over and over and over. I had a conversation with one of my daughters who had $100,000, and her money manager managed to mismanage it down to $60,000. And she said, well, what should I do? I said, if I were you, I'd get rid of that guy, and I'd get a more stable. Well, he talked her into staying with her. Well, it's going to come back, okay? Well, it's 2 years later, and it's come back $4,000 in 2 years, okay? So, again, we have to think about, and I want you to think about, saving first and investing second. I want you to think about a portfolio that won't let you down. I want you to think about, this is what I do. I can't tell you what you should do. I want 33% of my portfolio outside of pension plan and municipal bonds. Could be in bond funds, but outside I definitely want it. I want 33% of my portfolio in treasury notes, CDs, cash of some kind. And I want 33% of it in growth stocks or dividend-paying stocks. Now, but the key is, the problem is that you have to get all of your investments in one place. So you're able to look at the potential for growth, but you're able to look at the risk. Otherwise, you can't look at the risk. You don't understand what the risk is, because what's going to go up is the stocks. Well, if your stocks go up and you don't rebalance them, then your portfolio is back at risk again. So what I do is every quarter, we rebalance my portfolio so it's back to 33, 33, and 33. And this has earned a consistent 8 to 9% per year since I've been doing it. So you almost have to demand that your advisor does what you ask. That's the hard part. I mean, even when I moved my to the current advisors it took about 3 years of just, no, this is what it's going to be. No, this is what it's going to be. And finally, after 3 years, he's converted. He's a believer in exactly what I'm doing, because he's seeing how my portfolio is outperforming almost all the. But the problem is, advisors have people that come in and demand that they make high returns. As soon as the market starts going up, everybody starts to jump in, and now they've overweighted their portfolio. I don't know how many people I've talked to that had $3 and $4 and $5 million in 2000 and ended up with $500,000 when the tech crash happened. Actually, it happened before that. So you've got to be diligent to have your portfolio rebalanced each quarter. It's got to be rebalanced so you're able to look at it. I use, personally, I'm a Schwab private client. I like what they've done. They have 2 people looking over what I do. I pay 0.5 to 0.75% for my stock portfolio, and in that is included no trading fees. I pay 0.25% to 0.5% for bonds or mutual funds, and I obviously pay 0 for cash. So you have to, my statement to anyone is the most important thing is you have to determine what you're able or willing to lose in any one year. And then you have to really think about developing a portfolio that does, my number is 10%. And in 2008, I lost more money than I've ever lost since I've been doing this that I can remember from the beginning of and that was 8%. And I was still uncomfortable. This is the most critical factor in your investment strategy, especially in an investment strategy that's going, I think it's always been true, but it's more critical now because we're going to see the markets go up and down and up and down. And if you're not prepared to prevent the downside loss, you could have amassed quite a bit of money, but all of that money is going to be at risk. So the idea is save first, protect your downside. If you own a lot of stocks or mutual funds, you need to have some stop losses put on those at whatever number you're comfortable with so you don't go into this free fall. And because when the market goes down 10%, in most instances it's going to go down 20. When it hits 20, in most instances, not all, it goes down 30. So if you own your own stocks in your mutual fund, you've got to put stop losses on those part of your portfolio. And as I mentioned earlier, I'm going to say it again, you need to take all of whoever you put your money with, it needs to all be in one place, not scattered around in a bunch of different locations because you have no way to monitor your risk. So the first step is to put all your stocks and bonds in one place so you can determine the risk and gain of the entire portfolio. Otherwise, you don't know what the risk is. The second,
Cancel.
The second is I don't care who you put your money with. There are many, many good advisors. Many of the financial advisors use Schwab. As I said before, I'm a Schwab private client. I'm very happy with what they've done, but I'm sure there are many other good firms as well. I don't get any money and don't want any money for referring people to them. And by the way, every private client, every person that invests money is not the same. Most of the advisors at Schwab have no clue about this particular strategy. And the first thing they'll do when you walk in there is try to talk you out of it. Anybody will, because they want more of your money in stocks because you're going to earn more money and they're going to make more money doing it. The first step is to have your entire portfolio evaluated. And in most cases, I would say in literally every case, it'll be rebalanced for safety, for risk reduction, and lowering the cost of managing your money. Most people just don't understand how much risk they have in their portfolio, but they find out when the market goes down, don't they? So you've got to be able to measure the risk and return ratio. You've got to be able to do that, because if you can't, then you have no clue as to what your potential gain is, but also what your potential risk is. So we've got to measure the risk. I know I'm emphasizing that, but most people don't. And in fact, in any investment, if I can't measure the risk, I don't make the investment. I figure I've got enough risk, in running my own business. I've got enough risk running the center. I don't need any more risk anyplace else. So these are my 3 prime recommendation as sources. DFA is Dimensional Fund Advisors. Okay? Now, there are people that all they do is use dimensional fund advisors, and there are many advisors that use it, and they use it under the umbrella of Schwab. We, that is you and I, don't have access to this on our own. As far as I am aware of several months ago, you have to have an advisor to be able to do that. The other place where you get good information relative to stocks, dividend-paying stocks, is IQ Trends. So you can look at that up on the internet. Okay. Now, it went a little longer than I thought I would. I hope you're okay. I hope you learned a lot, or at least I exposed you and created some awareness for you. I've already had a couple one-on-one conversations with several people today. If you want to talk one-on-one with me about your investments, email me at mike@cfpd.com, and we'll talk about where to put it so you don't lose it. Now, keep in mind, again, I can only share with you what I do. I'm not licensed to offer you advice, so I will tell you what I do and exactly how it works, but I can't offer you advice. If you have questions or issues that deal with your practice, how to make more or earn more, how to keep it, you can either email me at mike@cfpd.com, or you can go to www.schustercenter.com/contact _US@ASPX, or just simply go to the website, fill out a form, and say, you know, I want to visit about these issues, and either myself or one of the coaches or analysts will talk to you. So if any of you have questions, please feel free about this. I think there's maybe about 21 or 22 people on this today. We're recording this so other people can see it again. And at the next session we're going to have together, I'm going to talk about common mistakes that people make in investing. So thanks so much for being here. I really do enjoy this. I know I can't see you, but I do know many of you are there, and I hope this is valuable for you. I hope it gives you some good insights, because there's no sense working to make it and working to keep it only to lose it. So thank you, and I'll talk to you soon. Thanks, Barb, for your help.